And welcome to our latest edition of Axon's live Q&A. As you can see on the screen,
pleasure to be back.
Good on you, mate. And you'll see so many of the clients come up: Sammy Wynn, Dane Gilchrist, Kent Herman, Angie Paradise. Like, you've helped every single one of these clients, mate, coming through. So there we go, Jace. What an absolute legend. So feel the love coming in for Jace coming through.
So good,
mate. How's things been with you? I think it's probably about when we did the Facebook Live Q&A in regards to tax time. So we want to in the lead up to the end of the current financial year, we want to be able to give people a bit of an understanding of what changes there's been from a tax sort of perspective, and how they can start to prepare themselves to make their lives easier. So when they do land in your lap and they get their tax done a few months after the tax time, unlike me, so they can get a tax return back sooner rather than later. So, mate, really keen on hearing your tips tonight.
Mate, before you keep talking, mate, for an hour, however long it needs, I'm just going to keep reading the quote.
Mate, it's great, isn't it?
I feel great. Yeah, this is awesome.
Benny Hinton's in the house. Luke Millwood, he's from the Gold Coast. Natalie Louise is in, Kelly Marie, etc. Mate, tell us, and I love doing this to all of my guests. I love putting people on the spot. I was going to say we'll come back to that, but no, I'm really keen. What's your observations of the financial landscape been? Shares, property, interest rates, whatever. Just if someone hit you up and going, oh, fuck, you're a financial planner and you're an accountant. Jace has got a little presentation he'll bring up shortly as Deb comes to join us as well, speaking about the financial landscape. There is one lady that knows everything about mortgage broking, finances, etc., equity. What's your observations been, Jace, over the last 12 or so months? And if you wouldn't mind, what if you had a little crystal ball, what would you say might happen in the next 12 months? This is a question everyone wants to know.
Look, for the last 2 years, mate, and I've probably said it a million times, I've said the world is upside down. You know, none of it makes sense to me at the moment. You think, go back 2 years, you know, into February 2020, and say that there's going to be, you know, a worldwide pandemic where no one's going to be able to travel anywhere. Someone like Melbourne is going to be the most locked down city in the world, you know, for the better part of the next 2 years. Supply chain issues, you know, people who can't go to work, and that is going to precede property markets increasing 40%, share markets. You know, you'd be like, mate, you're mad. You know, let's wait for everything to fall off the edge of the cliff, and then we'll pick up a bargain, which I know people were doing at the time, and unfortunately for them who didn't take action,
100%.
You know, they missed out on crazy returns. So, mate, things feel a bit. I used to be a stockbroker for a period of time, and I'll share this story in relation to that in a little while. But I was a stockbroker for a little while in 2007, 2008, and one of the brokers, you know, I just remember him saying to a client one day, he goes, "Oh, things feel a bit toppy." You know, and then obviously the financial crisis followed that, which was a short-term, you know, 2-year period of time where the market fell about 50%, the share market anyway. And obviously in America, there was issues around property, not so much over here. But, mate, I don't know. Like I keep saying, everything's upside down. Nothing makes sense to me anymore. You know, we're at record highs in all of the, you know, the financial industries that we work in, which is great. What's the right thing to do? I don't know. But I was just talking to you about my little story, which I share with a few clients, and I sort of question myself whether I should share it or not. And it's a story which has caused me to be down about $3 million and $150,000 a year in my own wealth. And that story is a story that I think probably answers the question better than understanding where we are right now. And if you want me to share it, mate, I'll just get straight in the show.
I do, mate. Give us a little two-minute version. I mean, ideally, we should be telling people how great you are, and you are based on the feedback. But sometimes hearing people's down and dump story and punches in the fucking stomach they've had to endure and still get up and be able to be as successful and amazing with numbers as you are, this is going to give you, it's a great point, Tammy from the Gold Coast as well. You either win or you learn.
Yeah,
mate, right now, buddy, how'd you get with that?
So this is the thing. These stories, as much as I'm, you know, a little bit still in tears about it all, makes me a better person, makes me do a better job for my clients. So there's 3 issues, mate, that I've had. One, when I was 27, let me go back a step. When I was 21, Natalie, my wife, her mum and dad gave her $5,000 for her 21st birthday.
Awesome.
And she started investing $200 a month into an investment. We call it pay yourself first. And all of the clients that are here today, you're all doing it. We do it with all the clients, right? Pay yourself first. Allocate a portion of your cash flow to your future self. Now, when Nat was 27, my business that I built up got bought out by a public company, and the shares in the public company were trading at 30 cents, and we were able to buy shares as part of the deal at 15 cents. So I'm making double the money instantly. My business got bought out for $750,000, which they paid me in shares. I'm 28, by the way, thinking I'm king of the world. We accessed every last dollar we had to put into the shares because we're doubling our money. We had about 50 or a bit more in super. Natalie's $5,000 plus $200 a month was $50,000. We had our own savings. We borrowed 75 from the bank because why wouldn't we? We're making all this money. Fast forward a year, the financial crisis, and that place goes broke. Now, I lost $1 million in that deal, but I'm not worried about the $1 million. The one I'm worried about is the fact that I didn't continue the good habits of Natalie's $200 a month and allocating that percentage of your cash flow towards your future self. Had we have kept doing it, I don't want to actually know the answer, but that investment today would be worth somewhere around 7 figures and make about 40 grand a year in income for us, right? Second thing that I did wrong, when I was 2008. So the same day that company went broke, I got a phone call from the boys at work. I'm a stockbroker at this point in time. And they said, hey, don't come back to work Monday. We've just had liquidators in here. The place has gone broke. We found out we were pregnant with our second child, and we just settled on our first house, a little house in Burleigh Waters. Bought it for $485,000. Now, I bought the current house that I live in for $1.2 million in 2015, moved in here, kept that property as an investment property, didn't need to sell it, but for whatever reason, I sold it. Now, I sold it for $540,000 from 2008 to 2016 is when I owned. So I made fuck all, right, in that period of time. And this is an answer to your question about, what do you do in the market? I probably bought it at a high in 2008. I sold it and it had done nothing. I didn't need to sell it, by the way. It didn't cost me anything. It's probably now worth about $1.2 million and renting at about $1,000 a week. Didn't need to sell it. The debt I had on it was about 200 grand. Now, third and finally, my office, at the same time I bought my house, I bought my office in Mermaid Beach. It was number 5 and number 6 at Marcari Street, so 2 next to each other. I bought it for $650 for the 2 of them. In May last year, I sold half of it for 520 grand. Okay. I go back to work after Christmas, and the agent who works in the building goes, I just told the next door neighbor for 850 grand. And, and I'm looking at it going, not only did I not need to sell it, I could have actually just put a wall up and halved it twice and had 2 different rental properties and halved it. So there's about $3 million worth of wealth, about 150 grand a year that I don't have, that I didn't need to sell those things for. So to answer your question, mate, like it's that little one-liner. It's all about time in the market, not timing the market. I said to a couple of your clients the other day, I said, once you understand that time is your best friend, time is your biggest asset. Once you really get that, then you'll do anything you can to build wealth and use the value of time. You know what I mean? Because like if you consider that you're going to stop work at a point in time, today is the longest from that point that you're ever going to be, because tomorrow it's a day shorter. Because you've got extra time, it means that today is the minimal or the smallest that you're ever going to have to do to get to an end point. If you want to get to $1 million and you've got 10 years, you've got to put away 100 grand a year. For example, if you wait 5 years, you've got to put away 200 grand a year. So every day, what you've got to commit gets a little bit more. So if you use, I did it. Natalie started it. We had the property. We had everything, and I fucked it up. And so I started using time wisely, and I made a mistake. But it makes me better to be able to help more people, because I know that it hurts. I don't want you to hurt. I've already doing it. And I'm better off for it anyway, mate. But to answer your question, you've got to be in it, continually in it. The market is volatile; it goes up and down. We don't know when the top is. We don't know it's going to fall. So yeah.
Friend, there's a reason why I call this business Axon, buddy. Everything's about the mindset. I'd love to hear, ladies and gents. We've got some cracking bloodies. That story hurts, Jace. Wow, what a story! So much to learn. Oh God, I don't know where this is going. Vulnerabilities are great. There's a trait of an amazing leader, Benny. Yes, you're absolutely right. It's certainly something mate, that I'm working on a lot. And I've got mountains to still share with everybody. So hold on to your hats there. I'd love to hear though, ladies and gents, what's the one key lesson you took away from that story? Right. So let's keep talking, Jace.
Yep.
How did you fall in love with the numbers, mate? Because you are a whiz, and there's a little known amazing skill you have. You're a absolute Top Gun, best I've ever come across. People are going to have no idea what I'm about to fucking say here.
Me either.
Start from scratch. Wonder what your wife's thinking. Start from scratch. Make it amazing. Blow everyone away. Poet.
Oh, I love my poetry, mate.
Aren't you? You love your poetry. Yeah. And I fucking take it for what you know I am, ladies and gents. I've heard this man crank out poetry from a fucking moment's notice, and just it is phenomenally good.
Mate, it's a funny one. It just comes to me, and it comes to me quick, you know. But the numbers, I don't know, mate. I love money, mate. I don't hide the fact that I want to be wealthy, but I always say to people, you know, for me to get what I want out of life, I need to help a lot of other people get what they want out of life, and that will cause me to win. And so I just like I like nice things, mate. I remember when I was in grade 1, the teacher asked this question, you know, if you could do anything, what would it be? And I said, I would like a time machine so I could go back in time and bet on the winner of the Melbourne Cup. Yeah. Only because I knew that would cause me to make more money, you know. Numbers just come naturally to me. Numbers come naturally to my kids. I love seeing patterns in numbers. I remember when the year that I bumped into you guys in Hawaii on holidays, we got in the hire car. I opened the door, turned the car on, and the mileage on the hire car was 12,345. I'm like, oh my God, this is going to be a good trip, you know. Literally, we've just got off the plane and got into a car, and that's the mileage, like stuff like that, you know. But it's just numbers, mate. I just, you know, I that's why I'm in the industry that I'm in. You know, just numbers are what I do. They're my language.
Love it. Look at this. Time in the market, hold unless you really need to sell. Benny Hinton, don't sell the gooses that lay the golden egg, as per Nicky Otto. Time, CJ. Time is an astoundingly powerful asset. It's a diminishing asset. Very true, Luke. The longer you wait, the less on your side. The earlier you execute, the more powerful it is. So if you're able to just bring some of these up, buddy, as I'm reading them, that'd be great. Debbie says Jace is a very humble man, and it's awesome that he can share his experiences to help the rest of us. 100%. And then Francine also said, geez, Francine, I think you're like a first time listener, first time caller. So that's really good. Smart choices is my learning from that. Never stop investing. 1, 2, 3. Oh, my very first unit in the military was 8/12 medium regiment. I see 12 past 8 a.m. 5 times out of 7 when I randomly fucking look at the clock in the morning.
Yeah, it's crazy,
it's
mate.
Like, catches my eye. I'm like, fuck.
Again,
it's like 33 years ago.
Mate, it's the same thing with me, 11:11. I see it most every other day at least. You know, I was talking to my kids about it. We were in Sydney 2 weeks ago, talking to them about numbers, and I go, look at that time, kids. It's 11:11. You know, so 2 days later, look at the time. But I don't know, mate. It's you know, as I said, I'm passionate about what I do. I genuinely want to leave the place a better place than I found it, and I act in a manner to do that. You know, I'm not trying to toot my own horn. I just, you know, I have morals that I need to stand by, and my actions need to stand by those morals. You know, and you know, I always say to people, if I can show you that you can do something better, and I'm going to show you in a little presentation tonight how we do that. Then we'll show you. If we can't help you, then I'm going to give you a high five and say, mate, you're killing it. Like you don't need help. And the thing, mate, with your clients, because I've talked to 300 of them in the last 6 months, is that they are all going to do well. You know, every one of these guys is going to do well. A lot of that's to do with military super. It's second to none. But you know, that we can always help people as well. We can always show people. And from my world, it's about habits, automation, and discipline. Mate, look, here it is. Here I went down to Sydney and I bought some books. There's a few of them, but here's the one, right? That's the one. You know, there's so many little one-liners in that book about, there it is. same. Yeah, mate, it's just about doing the right thing, you know, not morally, but like, you know, with your money, so to speak, for as long as you can, and you are going to do well. I love it when I get your clients that are in their 20s.
I was just about to say, it's Tamara's favorite thing as well.
Yeah, mate, you can show them with our modeling tool. We show them Like, hey, when we first chat to them, they go, "Oh, I'd like to retire at age 60 on 75 grand." And when we come back to them, we're like, "Hey, how's retiring at age 50 on 180 sound?" And they're like, "Holy shit!"
That software modeling program, and Aaron, I saw your name come up before. I hope maybe you, Tams, is listening as well. I actually love speaking to people that are my age, late 40s, soon to be in their 50s. And some clients I even spoke to during the week that have now booked a coaching session with us that spoke to a very long-standing colleague of ours that has a bald head a couple of years ago, and he smacked them over the fingers about being bad with their money because they didn't have anything and they were focusing on the kids. But now they're in the fact they're like 47 years old, they're about to be double income, no kids again. And I'm like, you've still got 13 years until you even turn 60. There's so much money can be made and so many good choices can be made and so many great habits that can be put in place. And even then when you get to 60, it's almost like a big fucking guillotine falls down and says you can't work anymore or this fucking show's over. Yeah. Like, Jesus, there's so much still to be done. Like, so my message to everybody is that if you're in your late 40s and you're just getting started, so what? Because you've got like most people are at the maximum earning potential of their life because they've climbed the corporate ladder or the military ladder or whatever it's going to be. Mum's gone back to work because there's no kids anymore. Like, there's fucking earning potential and borrowing potential. Deb, the loans that you and I have I've never written a loan. The plans that I've put together and the loans that Deb has written for people in their early 50s over the last 5 years is like dozens. And they're so fucking happy that they're buying investment properties in their early 50s because they know they've got at least 10 or 15 years to hold on to them. And if the market keeps doing what it's doing right now, coupled with a share portfolio and using their super and all those other bits and pieces that you do, Jace, there's nothing to be down in the dumps about being in your late 40s when you're just starting your wealth creation career, I assure you.
Mate,
if you've got the right mindset anyway.
Yeah, that's it. And like you just have to do something, mate. Again, it's in that Atomic Habits book. You need to master the art of showing up. There's no point to go, oh, woe is me. You've just got to, get moving. And I'll show you. All right, mate. Let's keep moving forward because I'm going to give away half the story here. But I talk about changing your mindset or you change your identity because once you start to make these choices, you in the future you now make better choices because the person that you've become. So I literally say you change your identity along the way. You know what I mean? So you're no longer the same person because of these things that you're doing. So you've got to take action.
Yeah, mate, I love it. What else was I going to just shoot the shit with you before we start? I want to do it the other way around. Ladies and gents, I've loved the interaction and that's in the stuff so far. So everyone's talking about, so Jace, our whole team read Atomic Habits. They had to stand up and do a little presentation last year. Jacob Johnson said, I want to retire by 40 drinking whiskey on the beach. Brother, there's nothing wrong with that as long as you got money in the bank. Aaron said, we hear you guys loud and clear. This is awesome news. So Jace, Aaron, I'm going to offend some people here. Aaron and Tamsin are going to be some of your favorite clients ever. They are such fucking awesome people. And they're exactly what I just described about them, about to move into their awesome brand new house soon, a little bit like what CJ and Sammy did. And they're about to do the same thing as what they're doing as well. But because Aaron spent much more time in the military, they've got a greater platform of wealth to sort of, project against. So it's going to be, I can't wait to introduce you to them. I said to them the other night, I said, have you guys been introduced to Jace Cosgrove yet? They're like, I said, because he services all of our clients. They're like, doesn't service us. And went, because you haven't finished your property yet. So that's why you haven't been introduced to him. And then as I got further and further into the circumstances without giving anything away, I'm like, fuck, you absolutely need to speak to him sooner rather than later. So that's that is on the way. Ladies and gents, please keep the interaction coming. As Jace is about to bring up a presentation at the moment, it's not death by PowerPoint. It's going to 15 slides.
Yeah, I'll go through it pretty quick too.
But you don't need to race through it because it's going to be a combination of tax, the tax guide as far as what's going on in this financial year to be absolutely making sure that people can prepare for what's going on with their tax. But then Jace is going to give you a little insight into this, a simple little wealth modeling tool that we talk about, so you guys can have the peace of mind that you can put some variables in now, which changes the trajectory of what your sort of future is going to look like. Aaron Ryder says, "Be careful what you wish for."
Mate, just on that, Robbie, the couple of little present points at the end aren't even to give you guys a sneak peek at the tool. It's to give you guys a sneak peek at the reason why you need to consider your whole world. You're not your super fund. You're not your investment property. You are everything, and you are. Whether you like it or not, the actions that you take now are going to be utilized for the better if you make good choices in some time in the future, whether it's 5 years, whether it's 35 years. And that's what I want to get across, that the fact that this is an all-encompassing process here that we're about. So, mate, I'll share my screen.
In the meantime, team, go ahead and type in, like, you've got him here. We're here for you. What's your number one question? If you had like 5 minutes with arguably the best accountant and financial planner in the whole country, what would you ask him? And we're here now. So let's go ahead and do it. Go for it, Jason. Then Soph will help you out on the back channel.
What have I done? There we go. All right. So some tax strategies. So let's have a quick look. As always, this general advice warning. So basically, my little joke with this one is that I was never here. I didn't say anything. But what it does mean is that anything I say, you might be old, you might be young, you might be rich, you might be poor, you might be single, you might be married, you might have kids, you might not have kids. There's so many variables that I can't, deliver a message to everybody. So please, if there's something that sounds great, give me a call tomorrow or the next day, and let's chat about your specific circumstances. Your Wealth Corp, we're an accounting and financial planning business. We're down at Mermaid Beach on the Gold Coast. The beauty of us is we have in excess of 300 clients, courtesy of Axon, who are current or former Defence Force members. We're pretty well across military personnel with property, their super, their taxes, their wealth creation and the like. So that is a little plus to us because of the support that Axon has provided us over the years. But if I go back to the beginning of tax, and I want to explain how things work, because a lot of times people don't get it. And it really is simple once you get it. We have what's called a marginal rate of tax system. So if you earn under $18,200, you don't pay any tax. If you earn between $18,200 and $45,000, you pay 19 cents over and above $18,200. So a lot of people think if they earn $45,000, they pay 19 cents in the dollar. No, they don't. They only pay 19 cents on that amount within that bracket. And then we move on to 45 to 120, where that bracket is at 32.5, 120 to 180, that bracket is 37, 180 and over. Anything over that, the top marginal tax rate is 45 cents. So what I want to get across on this little part of it is that you don't pay 45% tax if you earn over $180,000. You pay $51,000, which is the sum of the 19 cents on that, 32.5 on that, 37 on that, and then 45% over that. Now, that's, I hope, makes sense. On the flip side is when you claim a deduction. So let's say, for instance, you earn $100,000 a year, and if you've got to go and spend $2,500 on something that you can claim a deduction for, you don't get $2,500 back. What happens is your income, which was $100,000, is now goes down to $97,500. So you've saved 32.5 cents on that $2,500, which is $700, about $800, give or take. So you've spent $2,500, you get $800 back. You get a third back of your money. So I hope that makes sense as well. 2 points on that slide. You don't earn, the top marginal rate and pay 45% on everything. It's a marginal rate of tax. And when you get a deduction, the deduction is only worth the tax rate within, your level of income. So it's pointless just to spend money for the sake of getting a tax deduction, because you're only getting a fraction of it back. Hope that makes sense. Robbie will let me know if there's any questions.
Interestingly, I just did a quick little calculation. If people can see my eyes moving on the background, I divided 51 by 180, and it's only about 28 cents in the dollar to that point.
Correct, mate.
So it's only 28 cents in the dollar when you pay your 51 grand over, but then it's only 45 cents for every dollar over that.
Yeah. So you're not even at 45% or anything like that there. Yeah. So if you're at 180 divided by that 51, like you said, it's 28% after that point. So very good point, mate. Very good point.
Not that I'm earning more than 180, but when I do get there one day, I think I'm not paying as much tax.
That's right, 100%, mate. Exactly right, and it's good to know. All right, so I pinched this straight from your website. So so on these next couple of slides is the way that it works for you guys. So let me explain it before I read to the page. So if you've got a job, Okay. And we go back here and your employer pays you $120,000. They've paid you $120,000 and they've withheld $29,467. So for the sake of it, let's say that's 30 grand. You got $90,000. They gave the ATO $30,000. Okay. That's how that works. If you've got any other income, so it might be dividends because you've got shares. It might be bank interest. It might be, something else in the form of income. And rental income is in there, but I push that toward the side and put it into the rent property schedule. So all of your income adds up, and that's your income. If you've got deductions, so you can claim a deduction for any expense incurred to generate assessable income. So if I'm an accountant, right now I've got a friend who's down in Adelaide at a self-managed super fund conference. Clearly I'm not there, but if I had to fly down to that conference and I had to pay for the conference and the flights and the accommodation, that's all me learning to do better in my world. So I would be able to claim the $5,000 or whatever that week cost as the deduction. Because I'm in a business, everything that is in my business is available. But, for things like you guys, like if I come across who that paid their ADF tax claims, if you've got to drive, from one job site to the other, if you've got mess fees, if you've got uniform, things like that, you're able to claim as a deduction. Any expense incurred to generate assessable income is tax deductible. One of the things that we all became familiar with over the last 2 years was working from home. So if you work from home, you can claim either way you want to do it. You can claim 80 cents an hour, and that's the whole thing, or you can claim 52 cents an hour, but you can also then claim your phone and your internet, as well. So I don't want to get too hung up on this because it's pretty simple, or not pretty simple, but it's not really that exciting. But basically we start with your income, then any expenses that you've got. So your phone, your internet, your uniform, your travel, whatever it is, you deduct that from. So we started before at $120,000. Let's say we have $10,000 worth of expenses. We're now down to $110,000. The ATO, or sorry, not the ATO, our employer withheld $30,000, which was great, but our income's now 110, not 120. So we're going to get 32.5% back. So we're going to get $3,250 back because we've got $10,000 worth of deduction. So that's how you get yourself a tax refund. And then when we come across to the investment property, it's its own little business, if you like. So it has income and it has expenses. Some of the expenses you actually pay, like interest and rates and insurance. Some of the expenses are non-cash, like depreciation. So the sum of that is your rental property income or loss. So you've got a rent property, it gets $500 a week, $20,000 a year. It's got interest of $10,000. It's got rates. It's got insurance. There's a bit of repairs and that sort of thing. Might be 15 grand. So you've made $5,000 in income. But if you've got depreciation early on, you might be able to get $10,000 or $12,000 of depreciation. Say it's $10,000. The property has every opportunity, and we see it all the time now because of interest rates being so low, where the property is positive for cash flow, but negatively geared from a tax point of view because of the depreciation. That non-cash expense has gone negative or caused it to go negative. So that's how it is. I mean, again, rental income is the income, advertising, body corporate, agents fees, stationery, some sundry expenses, interest on your loan, rates, water, legal fees, insurances, cleaning, gardening, pest control, and then the depreciation. So they're the most common ones. Don't see too much outside of that. So you start with your income from your employment and interest and dividends, whatever it is. You take away your expenses, your phone, your internet, you had to drive your car for work, some uniform, working from home. That's the net. And then we've got the property that comes on. And then the final number is what it is. That's your taxable income. Tax on your taxable income might be, $100,000 income, and it's, whatever that is, 28,000 or something like that. Whereas your employer withheld 30 grand and you get a couple of $1,000s back. That's the simple way to explain it. So mentioned at the start, Your Wealth Corporation. We are an accounting business. We service over 300 clients. We can do a good job at that. But I mentioned that we're about the holistic approach because, back in the day, we used to do, and it used to grate my gears where I was like, I just feel like we can do more for people. And that's where we're at now. So let's say if you do get a tax refund, what's the best use of your money? Talking about interest rate rises. Are they going to go up? The talk is that it's likely to happen. Future planning, your capital gains tax on properties if you have to sell it. Do you need to be insured? And super is, just some of the little ones. So let me give you a couple of snippets about what I'm talking about. I'm going to address the minimize or elimination of your future CGT and the best use of your tax refund. Okay, so let's say you had a strategy which was outside of super, outside of property, pay yourself first strategy. I talked about it before when Natalie set it up. $1,000 a month, earning 8% becomes $1,017,000. Okay, now that's just setting up and using good habits. A lot of our clients, well, most of our clients do this strategy for themselves. A couple of things I talk about in here is the boring end of the curve and the exciting end of the curve. You can see down here, 1, 2, 3, 4, 5, 6, took 7 years to get the first 100 grand. 1, 2, 3, 4, took 5 years for the next 100. 1, 2, 3, 4. And then, and then it gets quicker and quicker. But we talk about time. If you've only got 10 years, then you only get out to 10 years. So if you've got 30 years, from here, it doesn't come up for me like it usually does, but the investment here grew by $60,000 or $70,000. Oh, there we go. Look, 68,922 in the final year. Took 1, 2, 3, 4. Took 5 years to get there. Now that's just happening with good money habits and allocating some money to your future self. What happens though? Let's say you get a tax refund of $5,000 a year for the first few years, which slowly decreases because the property becomes positively geared, but you're using the positive cash flow to your benefit, and you continually add an extra $5,000. It becomes 1.4 million, not 1 million. So you've got $400,000 more. Now, if I go back here and say, what's the best use of your tax refund? If you need, Robert, you talk about it all the time. You've got two forms of income, your rental income and your tax return as an income. Okay.
Yep.
If you need the tax refund to help you to maintain ownership of that property to use for, the loan repayments and things like that, great. That's where it needs to be. If you're using that money to save for another property or something like that, you've got a short-term objective. You don't want to be invested in the market, which is volatile and goes up and down like this. So you keep it in an offset account. If you don't need the money and you're not saving for it, what's the best use of it? You don't want to put it into the loan where it's going to get a 3% return when you could go and invest it out here. I usually model 10%, but I've kept it at 8% for today to be a bit conservative. And so we want you to do something better with your money, which goes an extra $420,000. Now, importantly, imagine if you get to retirement and you want to live on an amount of money and you're retiring in your 50s, you don't yet have access to your super, and the property may not generate the income that you want. This investment here can do two things. One, you can use it because it's a liquid investment. You can sell down $10 of this money. You can't sell down $10 in property. So we've now created this circle where this side of things is really going to help you out. But you can do two things with this money. You can sell down just enough to live on, but more importantly, you can sell down just enough, whether it's 150, 200 grand, whatever it is, to pay off the loan. So you don't have to sell the property to pay off your debt and be subject to, hopefully, a significant capital gains tax. And let's say if you do sell that property, we can use that money to salary sacrifice into super and take advantage of different strategies to, as they say there, minimize or eliminate your future CGT. So I said at the beginning, whether you like it or not, the actions that you are taking now are going to have a pretty drastic effect on your ability to do things down the track. And down the track, i.e. time, okay? It's using the time to your advantage. If you don't use it, you lose it. Time's your biggest friend, but the problem with time is it has a diminishing value. I'm going to get into my spiel.
Oh, good. Nikki Otto's just saying, same. I love seeing how the little changes affect the longer term outcome. Tammy says it's powerful. Luke said, I love that graph. So yeah, mate, you're getting lots of positive feedback on this stuff. Keep going, please.
Right, mate. So the other thing that you guys need to know, you military guys, is that by default, your super is not set up appropriately for you. And and we advise every single client to change their super, and the impact is significant. Again, I used a very conservative option here. The client, this is your member and your ancillary components, $50,000 in them, salary of 100 grand, you're contributing your 5% after tax. The existing investment option you're in is at 8.29% over the last 5 years. The recommended option we suggest is at 10.96, so 2.5% higher. Over a 20-year period, that becomes difference of 173. So with our Your Wealth, Your Way program, we talk about taking advantage of time, and we break it into two. One, we say the ordinary done consistently produces extraordinary results. Get in control of your super and make sure it's invested appropriately. That is this. Our average for military clients is closer to $600,000, the difference that we have there. But it's something that we need to address and look at every single military person, because doing themselves no favors in respect of that. So if I go stop sharing, come back, I am back. I can see me again. Get review. So,
right, love it. What else,
mate? What else? All right. Do you want me to keep going?
I do. Actually, a couple of small points to note. I love that presentation about the investment property stuff. Of course, it's what we specialize in. A couple of things, ladies and gents. When you're in your accumulation phase, do you remember this whole thing we've been speaking about today is all about time? Everyone would have heard me say this, my little coaching philosophy. Good property investors don't actually just buy houses or property, they buy time. You got to put the right financial structure in place, working with Deb and working with Jace to make sure that when you're in the accumulation phase, your rent return and tax return are simply holding strategies. They're income that you're being provided so you don't have to pay the mortgage, so as you can hold on to the property for the long period. That's the first thing, right? So the income exists for that reason only when you're in, when you're starting your investment journey and you're in your accumulation phase.
And that's what I said earlier, mate. That's what I had, and I gave it away on that first property I had.
Yeah, it's perfect, mate. And the other thing is, Jace, is that a lot of people they don't understand why can't they claim all their stuff against their own home as opposed to just an investment property? Talk about that quickly.
Well, so again, it's the generation of income, mate. So if it's against your own home, you're not generating an income. So if I'm understanding your question right, you're only able to claim a deduction on something which is generating income. Your own home, your principal place of residence, where I'm living, doesn't generate income. So I'm not able to claim a tax deduction for the interest on the loan, for any of the expenses or anything like that, because it is not generating an income. And likely, not likely, but positively, I guess is a word to use. If I was to sell, or when you sell your principal place of residence, you're not paying tax on it either. So you can't have it both ways, but you don't get a deduction for the holding of your own residence. What
about those clients, Jason, you've seen it plenty of times before, that use their DOHAS and their HPAS and their first home buyers grant and their home builder when it was around to, buy and build and live in their own home for their current posting.
Mm-hmm.
Then they move out of that property and turn into an investment property. What happens then?
So then it does become an investment property. It's generating income, and everything turns green. Lights are on. Let's go.
When does the time start? When can they start claiming that stuff?
When the property is available for rent.
Right.
Yeah. So once that property, so you might go on a marketing campaign and it goes for rent today and it doesn't rent out for 6 months. I'm just using a stupid example, right?
That never doesn't happen with us.
Not going to happen.
6 weeks.
6 weeks. I used a stupid example to give the example, right? So you can still claim a tax deduction for all that time, even though it wasn't being rented out, but it was available for rent. That was the point of my time of saying 6 months ago. Hang on a minute, it's not being rented out. Doesn't matter. It's available for rent. So it's being marketed, whatever it is. So you get keys, you hand over, it goes on a marketing campaign from that day. It's available for rent 6 hours now.
Yeah, 6 hours. Well done. Now, I've got another question for you. What about if a client is getting a loan as equity from their own home and then using that as a deposit and cost for another investment property?
Yeah. So that loan, the intention of that loan is for investment. So obviously, you've got $1 million home, you owe $500,000 on it. That's non-deductible because that's your own home. If you go and get a $200,000 loan to put towards an investment property, the $200,000 is deductible because the intention of that of that loan is for an investment. The purpose of it is to generate an assessable income. So that's deductible.
Yeah. A lot of people don't realize that. They think that all debt against the security of their own home is non-tax deductible. But, and I know the answer to these questions, but I'm asking you so that everyone can know the purpose of that money as it comes down as your Axon plan is to go and buy an income-producing asset. So you go, Fran, you didn't know that. That's great, mate. Mm-hmm. At least one person's learned one thing tonight, mate. That was our KPI.
Yeah.
That was our KPI. So I just wanted to sort of clarify a few other things there from my perspective, property-wise. What else springs to mind?
Mate, a couple of things that spring to mind for me is the ownership of the property.
Yes, love that.
I had some clients yesterday, talking to clients. I'm like, who owns property? And like, we both do. And then we got chatting and the guy owned it before they met. And I'm like, how did you buy this? Like, did you buy half from him? And they're like, no. Like, well, how can you both own it if he owned it before you met? And it's like, well, we're both, on the loan. I'm like, oh, the loan doesn't matter. It's on the title, so you can both be security over the loan, but whoever owns the property on the title. And there's two ways as an individual can own it on title. You can be joint tenants, where Robbie, if it's you and I that own a property, 50-50, mate, regardless of how much money we put in, regardless of how we want to treat tax. Joint tenants, whether there's 2 people, 3 people, 4 people, you own it in proportion with the people. So 2 is half, 3 is a third, and so on. The other one would be tenants in common, where you might, for instance, myself and my wife Natalie, let's say she doesn't work and I earn a heap of money, and we've got this property that's roomies. We've got this property that's generating significant loss. And we go, well, hang on a minute, we want that loss to be able to be utilized from a tax point of view. So you put it in the name of the person who earns the higher income. And in that instance, you're buying it as tenants in common, where you're able to do different percentages. So it might be 90% to me, 10% to Nat. I get to claim 90% of the deduction. That only gets 10% of the deduction, but she's still on the title. The sting in the tail, obviously, if we sell that property in 10 years and that's not working and I still am, there goes the books, then I get 90% of the income. So, you can never run away from it. You never get it all your own way, but that's a couple of things there.
What about a married couple, mate? A married couple, and then so when I give that example to some married couples, and generally the mum, as might be back to work a couple of days a week or whatever. I'm like, look, you're earning 20 grand a year. Oh, mate, Jono, you're still earning 100 grand a year. Let's, as a suggestion to be ratified by you and the solicitor, let's, Jono, put the property in your name for 90%, and Sarah over there, you're bloody 10% per se.
Yeah.
But then of course Sarah jacks up. She's like, well, what if we split up? I don't want to lose bloody that much of the house. So I guess that when the family law court get involved, they don't necessarily care how it was set up from a tax perspective. Sarah, you're not going to lose half the house just because we're being smart with the tax strategies. Yeah.
Correct. Yes, mate. That's right. That's exactly right. Yeah.
Yeah.
And then I like that, mate. I came from, my mum and dad broke up, and my dad kind of got as much as he could get his hands on, and so I'm all about the fairness and go to bat for the girls in instances like this. But this day and age, it's even Stevens, mate. Super. I had this lady in my office the other day, very wealthy lady. She sold a business for about $40 million before she was 40. Ooh. And she's like, I had to give my bloody ex-husband shitloads of super, and damn, it pissed me off. I'm like, well, I've only seen one where the shoe's on the other foot.
Fucking 40 mil. That's yes, she is going. She's going okay.
Mate, wait till I tell you the story. Give me a call tomorrow. I'll tell you all about it.
Yeah.
I've
got another story I want you to tell in a minute.
Yep.
Can you tell that story? This was a defense couple that had broken up, and and their family advised them to sell the property they'd bought together.
Yeah.
And you spoke to them about the 12-month capital gains tax.
Yes.
Can you tell that story, please?
Yeah.
This is a cracker, ladies and gents, that as soon as there is a change in your circumstances, please reach out to the key people on your team: mortgage broker, accountant, financial planner, property coach, solicitor, somebody. Don't just fucking take the advice of your parents or your family or friends because they think they know better, because this could happen to you.
Yeah. So the lady rang me up and she's like, I just need to sell this house, need to understand how it works, broken up, mum and dad. She got into the house from a bit of an inheritance, and then her and her partner broke up. So all the money was hers, and she was going to sell it and get out of it. And because the market's done so well, she'd done pretty well on the property. And she was going to have to pay about, I'm going to say $60,000 in tax after owning it for quite a short period of time. And again, this property was like 90-10 in her name because it was mainly her money and she was earning good money. Anyway, so one thing we have in Australia is what they call a CGT discount, capital gains tax discount. If you own an asset for greater than 12 months, the gain that you make on the sale is halved. So if you bought the property, held it for a period of time greater than 12 months, and you made $200,000, half of it disappears for tax purposes, and the other half is what gets added on. So you only add $100,000 to your income. If the property's owned in joint names, 50-50, then each person gets 50%. And as you saw with the tax rates earlier, if you can own it in joint names, it's better because it goes up only at 50 grand, not 100 grand for one person, where you pay higher as you go. So we had a chat to the lady and said, listen, you know, like one, we crunched all the numbers for her and said, you don't actually need to sell it. You know, like and this is where I said before about me going through those lessons. It helps me to talk to people because I can go, here, I'll give you my story. All right. You take with this what you will. But if I wish I could still have that property, you know, from 10 to 12 years ago, whatever it was, 2016, 8 years ago, 6 years ago. But mate, had she have waited less than 1 month, the tax dropped down to like $26,000 if she would have held it from selling it. And one thing you need to know is that it's based on the contract date. Contract date to contract date is when the 12-month period works. So you might go and say, listen, we took it here and it doesn't settle until September, and we didn't buy it, you know, until whatever date a year ago. But if you went to contract in June, you know, and a 3-month settlement, and the 12 months from the prior contract was in July, and you go, well, it's been 12 months. No, it's not 12 months. It's only 11 months because it's based on the day you signed the contract. So just by having a chat, she rang me up. I missed the call, got the message on my phone, gave her a call back a couple of hours later, had a chat, and, you know, she's like, oh my God, thank God I called you because she already had the real estate agent booked to come over that night to sign the contract, you know, or to put it all in place. So, you know, the chat saved her more than $30,000, you know.
Yeah, because the parents are like, right, fucking, you're done with him. We're done with this property. Get it sold right now. They don't understand the implications of, you know, I get it, right? Paper, rock, scissors, Axon, family. So yeah, I'm more than happy the fact that people are going to rely on what their families say more than what we say. Got it, but please ground truth it with the experts, so you know you're not sort of being backed into a corner based on what Uncle Johnny thinks you should do with stuff. Yeah,
mate, and you're only looking after your best interest. That's the nature of it, but they just don't know. You know what I mean?
Yeah.
It's you know. And you know, like my dad, he passed away, and he was a pretty wealthy guy, and you know, he was someone that I leaned on for stuff like this because he had runs on the board. So if you are going to take advice from someone and you want them to be in a better position than you are, because you know they've been to places that you haven't, you don't want to be taking advice from people that are no better off, because you will end up where they are because they can only give you advice based on what they know. You know, that's one thing that I always, you know, when someone's trying to give me advice, I look at them and go, yeah, no thanks. You know, I don't want to be where you're at. But mate, Luke's got a good question. Touch on the pros and cons of owning through a trust. A brilliant question, mate.
Owning in relation to trust,
Yeah. So a trust is a structure. I'm loving these hashtags that are coming up, by the way.
Yeah, I know, it's great.
A trust is a structure. In Australia, you can, let's call it, run a business for the sake of it in a company. You can do it in a trust. You can do it as a partnership, or you can do it as an individual. And you can own it as in a self-managed fund as well. You can own property through a self-managed fund. So you can own different assets in any of those different structures. Companies don't get access to the 50% discount that I just went through. So you kind of scrap that most of the time for the purpose of investing. A trust is a great way to own an asset because it gives you flexibility over the distribution of income. So you don't necessarily have to decide Sue gets 10% and Mike gets 90% or vice versa if you're in a trust, because you have the flexibility to distribute the income in the most tax effective manner. The downside of a trust is that you cannot distribute losses. So we get a lot of your guys, and it's kind of in our office, everyone gets excited because we're a boring accounting firm, remember? When I'll be like, oh, mate, I hope you're sitting down. You're going to get $16,000 back as a tax refund because the properties, generated the loss because of the depreciation and things like that. If you've got the trust structure, it can't distribute the loss out to the beneficiaries. So you lose the impact of the negative geared, what they call negative gearing. Negative gearing is when the expenses are worth more than the income. You lose the benefit of negative gearing if you own the property in trust. The loss carries forward through the years and the years until there's a profit. So if it was year 1, 2, 3, 4, 5, and then in year 6 it became positive, if all those losses added up to 35,000, then you don't pay any tax on the income until those losses are eaten away. But you lose the impact of the tax advantage of that, that negative.
What about if you were to sell the property? Do those losses carry forward as well?
Capital gains are different to income. So the losses you can't offset a capital loss against income. Getting myself confused here. But again, mate. So one thing I was just about to say is that income must be distributed out of a trust. So you can't elect to leave it in the trust. It must be distributed. So whether it's rental income or whether it's capital gain, you distribute it in accordance with the trust. So myself, Natalie did our tax work today. She finished it off, and the property we sold, the half of Unit 6, 5 Marcari Street, or Unit 5 it was, and we made good money on it. And so she did the trust distribution 50-50 to each of us because we split our income 50-50. But yeah, so just to get clear on what I was mixing up there a second ago, if you've got capital losses, again, so you sell something for less than you bought it for, that's a capital loss. A capital loss cannot offset other income, okay? So you can't sell some shares and lose money on it and then have an income of 100 grand and a capital loss of 10 grand and say I made $90,000. Capital losses must be carried forward. You can offset a capital gain against an income loss. So if you had that trust, which had 5 years worth of income losses, negatively geared, and then you sold it, that capital gain can offset the income loss, okay? But the income gain cannot offset a capital loss. Capital losses can only be offset by capital gains. It's confusing. I wasn't intending to go there.
It's good, mate. You actually answered my question. So the on-paper losses that can't be distributed like a normal tax return, they sit there, and when you sell that property for a profit, it can sort of offset whatever capital gain might come your way.
Or if it becomes positively geared, it starts to offset it as well, which is probably more likely. Yeah.
Good stuff, mate. What else was I going to ask you? We're going to do another session where I want you to explain the Your Wealth, Your Way concept a lot more to give people an insight into what that sort of the wealth modeling stuff can do. And I guess as a bit of a teaser for that, can you just go through, and you did this with me and Tamara about 18 months ago, and it floored me and it stayed with me since. Because you're telling me about this software modeling. Say again, mate.
So the Your Wealth, Your Way, right?
Hang on a sec. And so you asked me these 3 questions.
That's where I was going to go. I knew what you were getting at, mate.
Questions. I'm like, fuck, I'm in the wealth creation game, and Jace has got, he's updating and upgrading and modernizing this tool that he's had for a couple of years now. And I'm like, the 3 questions that you asked me, I still couldn't answer on the spot. And I just had a penny drop moment. I'm like, everyone now needs to do this fucking session with you. So as a little teaser, ladies and gents, write these 3 questions down and go and look in the big mirror where a lot of us don't like looking. I've still got an ongoing battle with mine. It's a fucking daily thing, by the way. And ask yourself whether you know the answers to these 3 questions. And if you don't, you know where to find us. Go for it, mate.
How much income do you want to live off when you retire? How much wealth do you need to accumulate to make sure you can generate that income? And are you on track? That's the 3
how much
questions.
Income? Like how much? Like how many? What's it? Per annum income do you want to live off when you no longer work?
Correct.
What's that look like? How much wealth do you need to be able to accumulate between then and now to make that happen?
Yeah. And how much wealth do you have at that point? Yeah. And are you on track?
And are you on track?
And you know what, mate? You know what? This is how much this whole thing continually evolves. Is that I now follow it up with, and you know what? I don't really care. What I care about is the time you've got between now and when you retire, and making sure that you can do everything with that time to put yourself in the best point at that point. Okay. So Your Wealth, Your Way is, one, designed to give you clarity about what the future looks like. Two, to give you peace of mind to know that you're doing the right things all the way along the way. But three, and how you judge the value of it, to help you to increase the trajectory. So if you are taking actions that are getting you to this end point, my red banded watch out there, and that's $2 million at age 60 as an example. If we can show you how to do things better, whether it's change your super, whether it's to start a pay yourself first strategy, whether it's to stop putting so much money onto the debt reduction because you're getting a 3% return on your money when we want you to
property, whatever it's
going
to be.
Whatever, correct.
Yep.
And we can show you per our modeling that we've got you up here, which is $3 million. We've been able to help you to increase the trajectory by $1 million. So clarity about the future looks like peace of mind to know you're doing the right thing, but to help you to increase the trajectory. And so the whole point of it is that we show you the value that we offer before we even ask you to pay a cent. It's like we want to be able to see if we can do anything before we want you to pay for it. So yeah.
Tell me in the chat, ladies and gents, give me a hell yes, fuck yeah, whatever you want, whatever you're comfortable writing on your Facebook account. Like, first of all, does anyone have crystal clear clarity on the answers to those three questions? I'd love to know that. And second of all, let us know in the chat whether you think it's going to be worthwhile, that you want Jace to come back and do a 45-minute session with us again and show exactly the principles behind what happens in the sort of the Your Wealth, Your Way stuff. To me, it's a no-brainer. I have never, ever spoken to a client that's spoken to you and they go, that was a waste of time.
Yeah, mate.
Not in the last 3 or 4 years anyway.
Do you know that the couple that initially think, I'm not sure, have come back, a year later gone, all right, now I am sure. You know what I mean? Which makes me feel good, because I'm like, I always, okay, if they didn't like it, what didn't I get across? What can I change? How can I make it better? Whatever. It's I do like the fact that a lot of people are getting a lot of value out of it.
Yeah, of course. And that clarity that people have there about what, the decisions they're going to make tomorrow is actually working towards something.
Yeah.
And or if they don't do it, then it changes the trajectory straight away. And you can put the variables in, how much capital growth you're going to get, how much rent return you're going to get, what the interest rates are going to be. So, at the front end, every good graphical representation, Jace, you would agree, it only relies upon the data that's inputted up front.
Correct.
So people go, it's going to be fucking 40% growth in wages, 40% growth in rental yield between then and now. No worries. If that's what you're running off in your mind and that's what you think is going to happen in your crystal ball, fucking let's do that. So, it's just really good that people can be realistically, conservative there. Go ahead, mate.
Can't remember what I was going to say, mate. I've had too much.
Doesn't matter. Nicole Otto's I've got 95% clarity. I think I was about 70% Nikki, you've always been super switched on when it comes to your money. When I met you the better part of 4 years ago,
I
always
love
worth having Jace on. Really love enjoying with him. We've got clarity. Ryan McElroy, hey brother. I'm sorry I missed you on the weekend, man. I was fucking massively hungover on Monday. I had 4 nights on the piss in a row, so that's my excuse and what happened. And I know you're going to give me the thumbs up about that anyway. Having done the first session with Jace, I can say it was eye-opening and massively beneficial. The second 2 are hard to answer. They absolutely are. Because I saw down the bottom there, Fran Israel. She's like, I know the answer to the first one. That's how much I want to live off. How do we get there? She saw what the red watch needs to look like.
As I said before, the point of it is to get you in the best shape possible. And this is the whole point about wrapping everything up about your tax returns, because like I say, you get a refund and you got $5,000. The old you, if you were doing the right thing that you think is to go, oh, well, let's pay it off our loan and put it in an offset account or something like that, or maybe put it in the bank. But most people, probably not most people have investment properties, but most people get a little bit of money and they spend it. Okay.
Yes.
That's the whole point about how this bloody country works. Everyone spends all their money. No one's got anything. I literally say you change your identity. We get to a point where we have people that are doing so much and they come in, they're like, what else can I be doing? What else should I be doing? I'm like, man, you've got investment properties, your salary sacrifice into the caps, you're paying yourself first, like this significant amount of money. But we've got people, your clients, that are putting away $12,500 a month into the pay yourself first strategy. They're deployed on 150 grand a year. They're putting all the husbands away, living on the wife's income, retiring at age 50 on big money. It is so good, mate.
And even though you might be earning the big bucks now, and we've got people living over in PNG and the Timor and all that sort of stuff, but like if they're not doing things with that money and the opportunity they've got right now, it severely hampers what their future is going to look like as well, mate. So I'm so glad to hear those stories. Sammy Wynn, it's definitely worthwhile for Jace to do more for the members. I reckon one of the money mindset type sessions that the coaching team did via Zoom last year, instead of during a Facebook Live, though, we can absolutely do that, Sammy. Tammy's so powerful. We'll go through life guessing if we'll have enough to retire, but this system spells it out for you, and Your Wealth Corporation gives you simple tips on how to change your future. Fran, again, mate, you're on fire today, Fran. Fran, I should say. So many people get to retirement and realize they wanted to be better off. All of you here are one step ahead already. Make it count and get those questions answered. Love it. Thank you, Ryan. Jason and his crew are worth their weight in gold for clarity. Sign us up. Olivia, good stuff. And then Peter Rogosh, I got your message back through there as well, brother. I look forward to speaking to you down the track. Mate, there we go. 1 hour goes quick, doesn't it? Thank you so much, ladies and gents. I knew that like everyone is going to show you so much love. That would easily be the most creative and most, sort of informative questions that we've got with everybody. We will promulgate. So let's allow the financial year to finish. Jace, in early July or so, let's get you back on, mate, and let's actually go through some of those principles of the Your Wealth, Your Way stuff. It is a no-brainer, ladies and gents, that everyone should do this. Lukey Hughes said he's on track there. I'd love to know what your numbers are, mate, and what crystal ball you're using, because no one else has fucking got one. All right, see you later, everyone. Thanks, you, Tammy. Mate. We do have the checklist that we're going to post in there. Thank you. Actually, is Soph going to do that now? If not, go back to our webpage. We've got those little cheat sheets that you saw Jace have about the ADF and the property checklist. That's all coming your way. Go to our webpage and go to so there you go. Check the comments after the stream ends. All right.
And looking through those comments, mate, I'll touch base with you guys to get details of a couple of those guys that are interested to chat further tomorrow.
Yeah, Aaron Ryder, thanks heaps, Jason, Robbie, bloody brilliant session. And looking forward to the next steps. So glad you jumped on tonight, brother. We'll catch up soon as well.